Hey, another crazy week in the markets, huge sell-off, followed by a bounce on today's job reports and economic data. Depending on how you played the market, you could have gotten, uh, barring leverage, maybe a 2 or 3 point swing, depending on what you're trading, in the broad market. Could have been a really nice couple of days for you. Could have been a drawdown, could be kind of flat. Totally depends how you're positioning your portfolio, but there's certainly a lot of stuff going on under the hood. Uh, Ryan, I appreciate you coming on. You're a CFA and you're the chief investment strategist over at Sierra Investments in Ocean Park. Man, what are you seeing out there? That's kind of an interesting report today that was a little bit off of what the expectations were for jobs data.
Yeah, I mean, one of the most promising things today was the participation rate continued to go up and the unemployment rate went down, actually. So it was a very strong number. I was actually surprised that the market didn't go the other way because normally, right now, the market's looking for uh, bad news, economic news, anyways, that would help expedite the Fed to lower rates. But normally, good news is bad news right now. So it was a little bit surprising, but I think a lot of that negativity in the marketplace yesterday probably took care of that today. So we had a nice little bounce today.
Good news is bad news. Bad news is good news. Depending on what side of a trade you're on, always, I suppose. One of the thoughts that just popped into my head, Brian, is if you're in a regime where uh, bad news is good news, is that a regime where correlations between stocks and bonds has maybe changed? And
Uh,
looking for bonds to trade a little bit more like equities?
Yeah, I don't know what the regime changes, but there's definitely been a regime change with respect to correlation over the last couple of years. I mean, we've seen stock bond correlation increase to kind of like the highest levels since like the mid 90s. And so um, it's interesting with a lot of advisors now. Anybody that's been in the markets for the last 20 years or so has basically has seen basically zero correlation or even slightly negative correlation between stocks and bonds. But like when I was in grad school and doing finance courses in the 90s, I was always taught that there was like a point 0.4, 0.5 correlation between stocks and bonds. So for me, this is kind of like a return to normal. But for a lot of the young advisors out there, this might be a little bit of a shock. And you definitely do have to consider that in your investment portfolios because correlation does change your overall risk profile.
There's the correlation aspect to bonds, but there's also, and this is the part that I talk about a lot of, is the effective duration of bonds, and the duration risk, and in particular in some of like the indexes. So I talked to, there was another institutional manager that opened my eyes up to this on a previous NAAIM Confidential podcast, that he talked about how the egg actually had this effective duration of like 5, and over the last, I think it was like 12 or 15 years, the effective duration had creeped up to 10. And so you start carrying all this risk. Well, in the meantime, you had like less and less yield. The yield's getting compressed and the risk is dramatically increasing. And quite frankly, people found themselves at a point where you have an asset that is not yielding very any significant amount, and you now have all of this downside risk through the effective duration. And because the yield is so low, it's really in a way limited the upside, capture potential of the ag index in that case.
Yeah, that's been
That's
really,
before the
really.
correlations change, but I mean, you can almost look at it from a fundamental level and say like it just seemed like an asymmetric trade in the wrong direction
Yeah.
almost. How does that kind of play out and play into the correlation change between stocks and bonds, and
Yeah.
how these instruments, or indexes, maybe trade or evaluate?
Well, just talking about bond volatility, I mean, yeah, like for decades, basically the Barclays, the Bloomberg Ag was basically right around 4 to 5 years duration, and it would just bounce between 4 and 5 years, right, with about a 4.5 average. And then the last 5 years or so, I think it peaked almost just under 7 years. So I think it's still above 6 or close to 6 years right now. Um,
So it wasn't as
so
dramatic, but it had creeped up.
but that's about a 40% increase in risk. And so effectively you have to take that into account. And yeah, up until about June of 2022 or whatever, you were still getting really low, or 2021, you were still getting really, really low returns or yields. So the risk return profile wasn't very good. Obviously, yields have come up quite a bit, but the risk is still there. But what's interesting is in typically, if you look at the ag, and you just look at plus minus 50 basis point moves in a day,
Mhm.
that's about a two standard deviation move. That should happen about 5% of all days, right? But if you look at 2022 and 2023, those plus 50 bip or higher, or and minus 50 bip and lower days, they happen 25% of the time. So it's an incredible increase. And if you look at just the risk over the last 2 years, the risk has basically doubled. So the increase in duration accounts for almost half of that increased risk, but there's definitely something else happening. And whether that's just because the Fed has kind of gone through the fastest rate hiking cycle in history, or at least in recent history, anyways. Um, there's definitely additional risk in fixed income investing in the last couple of years, and investors have to take that into consideration. If they're using a historical model that's looking at average volatility or average correlation over the last 5 or 10 years, they're probably doing their clients a disservice by underestimating the amount of risk that they're taking.
Yeah, I think that's a pretty prevalent thing though in the whole industry, right? As asset allocators and portfolio managers, they look and rightfully so, they say we're long-term investors, right? People should be long-term investors. And so one of my observations is that I see these people say like, well, look at this correlation over the last 10 years, or look at this correlation over 100 years. And it's true it was, but how true is that going forward? And if you look at that going forward, how true is that it matches maybe your investment time horizon too? Um, because that mean reversion, if you will, right? Like if you believe it's going to revert back to a non-correlation and your holding period is long enough, like you might be able to average it out. But if it's shorter, like do you have to look at it differently and say what's going on kind of in the now and what's going to happen in the next, year or couple years or whatever when
Yeah, I
I
think if you're looking at like a 10-year or 20-year or longer kind of history, then that's kind of like your strategic asset allocation or strategic allocation. But if you're looking at the markets now and you can see increased risk or increased correlation, you can kind of tactically adjust away from those long-term strategic weights and kind of adjust your portfolio so that you can take that new information into account. But at the end of the day, you still want your clients to be aware of, hey, the portfolio may act differently than these long-term averages just because correlation has been higher and risk has been higher. But I think from a correlation perspective, yes, that can go down from now on out, right? So who knows? It might be zero correlation for the next 2 years. We don't know. But duration is definitely still higher than what it has been. And until you see that duration go down, you're still going to see a little bit of an increased risk in bond investing. So you can definitely make some adjustments and be a little bit more tactical in your investment approach, just at least in the short term.
Yeah, I think back to when I was in school, and I was in school during the ZERP policy, and it was always this thing like where equities were that was like the sexy thing to talk about, to invest in, and you could make these incredible gains or whatever, right? Like that you could lose it all, right? But that's where people like that was the excitement, right? Was the equities, and almost to the point that everyone in school was like, man, what do people even have bonds for? Like, what is this? It's like this has got to be the most boring segment of finance ever is bonds and bond pricing, right? You're like you dreaded it almost. And it wasn't until I got kind of in the industry and then got around name and institutional managers and really started to season myself that I learned that bonds is actually like the most exciting part of the market because it drives so much. It can be traded so uniquely. It can be traded on fundamentals. It can be traded on technicals. It has a huge impact on you Fed policy and government policy, international events. It's like the bond market drives everything. And so great bond managers are really a great resource to have or know. But I'd love to know like what's your guys' take? Because obviously you do a lot of bond management and managing bond trading and looking at bond markets. There's a lot of uncertainty about what's going on with the Fed and cutting rates and implied cuts versus what their forward guidance is, and economic data coming in. Commodities have been having a nice little tailwind to them, broadly speaking. And that's adding, fears that inflation is going to, resurfacing and now Fed might not cut. Like, how does this play out? And what are the opportunities? A, what are the opportunities? B, what are the risks that people might have lurking in their portfolios that other, advisors or managers should be aware of?
Yeah. So, I mean, you touched on a lot of things there. So, first of all, I agree with you that the bond market is actually pretty exciting because there's a lot of different areas that you can invest in. And for us as investment managers, we like to be unconstrained. So we could easily, wherever there's an upward trend, that's where we're going to be invested, whether it's muni bonds or whether it's treasuries or whether it's high yield or convertibles or emerging market bonds. We'll try to seek out those positive trends. You talked a little bit about ZERP, and I go back to um, my father was a saver. He didn't want to invest in the stock market at all because he didn't like seeing his investment portfolio go down at any given point.
Mhm.
Um, but then for the last, I guess, since 2000, the early 2000s, when the Fed kind of went through what I call ZERP 1.0, when they dropped interest rates to 1%,
Yeah.
which was shocking at the time. Um, I mean, you had negative real rates and you haven't had a positive real rate until last year. And so for those savers, they were actually seeing their wealth actually be destroyed from inflation over the last 20 years. And so, but what was the Fed trying to do there? They're trying to incentivize investors to go into riskier assets, right? Because they didn't want people to just park in cash. They wanted to make sure that money was flowing through the economy and working and
Mhm.
uh, multipliers and unfortunately that put a lot of people into a lot of riskier investments chasing yield than what they normally would be comfortable with, and that really hurt in 2022 and 2023 when bond portfolios went down 10-20%, and even on the long term they went down 40 or 50%. That was a kind of a shock to the system because we've just ended a 40-year bull market in bonds. So with respect to the Fed, it's actually interesting because the the Fed was basically telling everybody we're going to continue to raise rates and be restrictive, and the markets were just not buying that for the longest time. And now that we're I think we've hit peak interest rates in this cycle, anyways, on the short term, and the short end. Uh, but the market was constantly assuming that the Fed's going to cut 4, 5, 6 times next year or in 2024 by December. And it's only now that you see the Fed in their last economic projections forecast 3 cuts this year, and the market's finally in line with that with 3 cuts. My only point on that is that the Fed will only do 3 cuts if everything else in the economy lines up exactly the way that they're expecting it to. And so if inflation stays strong and unemployment stays and employment stays strong, uh, we may only see 1 or 2 cuts this year.
Yeah.
So that's going to be very interesting to see how that plays out. And um, one of the interesting things about wage growth is the minimum wage, and it's kind of on everybody's minds here in California because we just went through fast food workers just got a nice bump up from $16 to $20 and on Monday, and immediately a lot of fast food chains actually increased their prices. Not all of them, but some of them did. So it'll be interesting to see how that plays out.
Yeah,
because
that could increase inflation.
yep.
That could be a real wrench in the Fed's plans there.
Yeah, I think the bigger thing with inflation, two things that are not counted in inflation is basically like auto loan interest payments and credit card interest payments. And we've seen finally that those kinds of debts, those interest payments are actually larger than mortgage payments now, mortgage interest expense. And that's a big cut from people's discretionary budget to spend. And so um, the San Francisco Fed has a great chart about excess savings during the pandemic and how people have been winding down those excess savings that they've accumulated. And we're pretty close to running out of those excess savings. So it'll be interesting to see whether people continue to spend like they are now, or whether they actually start curtailing like, are people willing to take a cut in their standard of living because they've run out of savings, or are they just going to not save anymore, or have
I
negative savings?
Yeah, I'm not sure. I feel like I've been hearing about that for several years though. Like we're the consumer strong, but it's running out, and it's like been running out for like 2 years. It's like when does it end? And I don't know. Is where's when people they're running out, but when you get a 4.4% inflate wage growth, then people are still getting raises, and things kind of have the potential to turn around. And people had so much home equity. I
Yeah.
mean, at a certain point, you might see people refinance maybe like credit cards and auto loans into home equity, and cash out refi mortgages to help manage expenses. Which is probably not great for the economy long term, is my opinion, but
Well, if
maybe.
you the couple cracks that are happening now are basically credit card delinquencies are up quite meaningfully, not at the levels from 2008, 2009. So credit card delinquencies and also auto loan delinquencies are creeping up. So basically, anything that's 90 days plus overdue. And so, but housing is actually in a really good situation. So there's not really that much uptick in housing delinquencies. So there are starting to get some cracks in the consumer. And so we'll see if that continues, because that could be a red flag coming up soon. With regards to housing, though, I think the most important thing about how, like, in a free economy, you need to have the free flow of goods and services, and that includes labor. And now that everybody's in their 2-3% mortgages, there's really not any longer almost a free flow of labor moving from job to job. So if you're an employer that wants to hire someone from not even just out of state, but across the state, you have to give them a pretty big incentive to actually sell their house with a mortgage of, say, 2 or 3%, and then have them come over to buy another house that's already been um, pushed up in price, but also taking on a 7% mortgage, right? So I think it's a small thing, but it's just interesting that I think companies now have a much smaller sort of uh, area by which they can actually find good candidates. And I think that's something that people don't really appreciate as much.
Do you think that could be one of the things that is almost leading to the strong employment numbers? Like employers are almost more hesitant to let people go because they know that they can't have the same reach to go to different geographical markets and bring talent in. It's a lot tougher, and so they'll kind of maybe be more flexible with the current employees and staff that they have.
It could be, but then your productivity is going to go down, right? Because you're not getting the
Yeah, it's
best of
not
the
great.
best,
Well, and it's like not a great long-term solution. I'm just wondering if
right?
that's what is helping prop up, if is that a factor potentially helping to prop up this job market, right? It just seems to just keep growing. I mean,
Yeah,
if you have a growing job market, growing wages, and quite frankly, it's growing real wages. It's not lagging in inflation anymore, right? If you have a wage growth that just came in at 4.4,
yeah.
it's above the inflation rate. As a whole, not all categories. Obviously, some categories might be significantly higher than that.
But
but
we've got a really long way.
that's a really interesting point that no one has actually articulated to me. That's the first I've heard it. That's
Yeah.
about just the illiquidity of talent almost
Right.
because of the housing constraints.
Yeah, I think that I still wouldn't call the housing market the job market healthy, just from the standpoint of like we still have a long way to go for our labor participation rate to go back up to what it was, not even just pre-pandemic, but what it was 5, 10, 15 years ago.
Yeah.
So I think that's a big problem.
And do you think the increase in participation rate that got printed today with the jobs report is maybe what gave the market the lift? Because you had the market. I mean, it certainly had that sell-off feel yesterday.
Yeah.
Again, feel nothing quantitative coming out of me here. That the market was concerned about this print. And
Well, it was also
and
like
the Fed rate hikes coming off the table because of it. If the jobs came in looking too good, so good news is bad news. And there's this cascading sell-off in the last, I don't know, what was the last 40 minutes on Thursday before the close. And then the print comes out at, early this morning. And it's what that report was almost worried about. And then the market rallied up. I mean, the Nasdaq closed up just over 1.25% today. S&P 500 up over 1%, and it kind of rebounded on almost all of that loss that sold off yesterday. On what,
well, I think there was also some Fed speak yesterday with people saying, "Hey, we may not be cutting 3 times, or maybe there's no cuts needed, or only just one." So I think yesterday was impacted by a little bit of Fed speak as well. So I think it's just a little bit of reversal from yesterday, and I don't necessarily think that it was necessarily just the jobs number that pushed the market up higher today. So, but it's interesting. The market is pretty fickle like that. So everybody tries to find reasons of why the market's going up or down, but sometimes it's just the market's doing what it's doing. We try to avoid kind of those short-term noise and just look at the long-term underlying trends, and seeing what's going up, what's going down, what should we be invested in, what shouldn't we be invested in.
Yeah. That's interesting because one of the things I've learned being around members of NAAIM, right, and this organization is that the bond market just seems to move so much faster than the equity markets, right? In terms of trend lines, maybe if you will, right? Like so, boiling that down to maybe like if you're looking at if you're someone that looks at moving averages, right? And you're going to invest in equities, you want to typically try to draw out those to a longer time frame, right? And kind of avoid some of the whipsaws that could come with a shorter term moving average, right? Or a signal based upon that. And then in the bond market is actually the opposite. You almost just shorten it up because the bonds sort of move so much faster in the price when they do change trend. What's your, I don't know, what's your take on that?
Yeah, we actually look at it slightly differently. We just look at the bond market in terms. Well, we just look at underlying risk. So obviously, with a less risky instrument or an asset class like muni bonds or floating rate notes, we're going to look at a much tighter volatility, and that's going to go into our signals versus something that's a little bit more higher risk, like high yield bonds or equities. That's going to have we're going to use a little bit wider volatility bands around that when we're actually coming up with our signals of what to buy and what not to buy.
Always volatility adjusted, and it always comes down to position sizing in portfolios, I think.
Yeah.
So what do you think the Fed ends up doing here, Ryan? I don't know. It's crazy.
Yeah.
What do you think and not to put you on the spot and make a call, maybe what do you think could happen? Not saying what you think will happen, but what could happen and what could be the impacts of that on people's portfolios? Again, just like going back to like effective duration, right? If the Fed doesn't lower, do you see an increase in the long end of the curve? And what does that do to people's portfolio if they're not paying attention to effective duration? Is there a play to maybe take on duration risk, right? Is that a prudent thing to do right now? What's your guys
Yeah,
so
we're gonna
your take.
for us, we're gonna wait until we see a positive trend in duration trade before we get in for sure. So we're definitely not bottom pickers or anything like that, or fundamental at all. We're very rules based investment managers. With regards to the Fed, um, I still think they cut, but I think it's going to be whether they cut once or twice. I don't necessarily think that we'll get to three cuts this year. But I think from the Fed's perspective, they've got to basically address it in terms of, hey, we know we've gotten into restrictive monetary policy. Like restrictive monetary policy basically means that we want the economy to slow down. We want unemployment to go up. We want people to spend less. And they're trying to achieve that so that they can cool off inflation. Um, but their communication with any cuts is just basically, hey, we can lay off of that brake pedal a little bit because inflation has been a little bit lower or closer to our target. We can kind of ease up on that restrictive while staying restrictive or just less restrictive. I think the Fed is, see, all of us in the investment world, we can change our minds every single day.
Yeah.
But the Fed, they only get one shot at doing this, right? And so if the Fed changed their minds as often as we investors change our mind, we'd be calling them they'd be flip-flopping a lot. But so anyways, the Fed has been very consistent in what they've said over the last few years. And so yeah, and that's what I think is basically going to happen, that we'll see a couple cuts. Um, all bets are off the table if we start to see a real deterioration in the economy, whether it's from, and I'm not an expert on this, but commercial real estate or anything like that. That's where some cracks, and obviously from the consumer, if we start to see increased delinquencies and people actually cutting their spending, that's going to be the big drivers that may cause a bigger recession.
What about geopolitical risk? We took it like looking at Israel, the Israel conflict and China invading Taiwan, which I'm not a big, I don't have a big concern on that stuff, but there's a lot of like there are people that are concerned that would, happen or different, just major geopolitical events. I feel like when I've gone back and looked and done some studying, it seems to always be like war's pretty inflationary. And it's oftentimes a good idea to almost like if the market dips on invasions and stuff, decent time to buy potentially.
Yeah.
But what does that do to like Fed policy and the ability for them to cut rates? Because I feel like they're in a tight spot right now, right? They really are. They're restrictive, but almost just barely, if they let off that break a little bit too much, like some things could really cause inflation to kind of tick up. Like they're almost in a little bit of a sweet spot right now, maybe a little too restrictive, right? But not,
Excessively so.
yeah,
Yeah.
and obviously the long and variable leg conversation, but
Yeah, well, the Fed definitely does not want a repeat of the 70s and early 80s when they cut too early and then we had a respike of inflation. And I think more appropriately would be the comparison to the 1940s after World War II, when just like COVID, we had a shock to the system. Same thing with World War II. There was a shock to the economy as well. And then when everyone came home again, there was a big increase in inflation. And there was a double hump in inflation then too. Yeah, so the Fed is very worried about reigniting inflation because that means that we're going to have to go higher than what we are now in terms of interest rates to get that under control. So
yeah.
yeah, the Fed only has one shot at doing it, so they want to make sure that the risk is asymmetric for the Fed, right? If the Fed cuts too early and you get reigniting inflation, that's a much worse outcome than if they just wait a little bit longer to cut and we may get into a little bit more than just a soft landing. We push ourselves into a recession. The risk of going into stagflation or something like that is a much bigger danger for the Fed. So the risk is asymmetric. So that's why they're kind of leaning towards slow and steady as opposed to what the market wants them to do, which is cut right now.
Yeah. At what point do you think this starts to affect the long end of the yield curve?
Well, it was interesting. We had a really good rally in the fourth quarter of last year, and then it kind of petered out. And then we've had interest rates on the long end creep up again.
But not meaningful, and it's still quite inverted, you know?
Yeah. And so, I mean, it'll be interesting to see. I don't have any particular views up or down on the long end of the curve. I think the normal situation is that we do have a normal yield curve, meaning that the short-term rates are lower than the long-term rates. But I think that has to happen in the long term. So it just depends on how is that going to play out? Is that going to play out because the Fed reduces the short end, or is that going to be because there's going to be a continued bear market in the long end? And I would probably say the former rather than the latter there. So yeah, I think I don't see long-term interest rates going up too far um, in terms of like getting back to a normal yield curve. I don't see long-term rates get up 2% from where they are now.
Yeah, that would probably tighten up the economy.
Yeah,
That'd become really restrictive really
yeah,
quick.
yeah.
But at the same time, you can't have an inverted yield curve forever, right?
No.
So you have to, I don't know, maybe it's a combination. Is there a potential that when the Fed cuts that the long end starts to lift?
Well, I think the biggest risk in the long end, I think, is all these continued government deficits, right? And so I think that's the big thing. And there's a lot of government debt that's coming due that has to be refinanced. That's going to increase interest payments, and there's a lot of deficits. And the higher interest expense is not helping things at all. So the interest rate payments is going to be an increased portion of the federal budget. And there's no on either side of the aisle, there is no incentive to actually come up with a balanced budget whatsoever. I mean, the CBO is forecasting increased deficits over the next decade. And the unfortunate thing with the economy is that just crowds out private investments. And so if the government still has to finance their deficits, and uh, perhaps to clear the market, interest rates do have to go up a little bit on the 10-year and up. The bigger problem is that with this crowding out and higher interest rates, higher credit spreads, is that you've got a much higher hurdle rate for private investments to do development, right? So previously, if there was a project that had a 6% internal rate of return and you could make that work, then that was great. You did that. But now that, like, if you talk about people may need a significantly higher internal rate of return on their projects to actually go through with it. So that's I think that's going to impact our longer term kind of productivity and our longer term growth.
Yeah. It's always crazy how fast the bond market moves and the impacts that it has because it really does drive everything. Everything from real estate to development to then, trickles into private investment and the political landscape and how people vote. I mean, it's really quite impressive that like if somebody's not paying attention to the bond market and just paying attention to something like the S&P 500 index, you're wildly missing the mark, in my opinion. So it's always fun to have these conversations. You've shared some really great stuff, Ryan. Now, NAAIM has their conference coming up at the end of this month, April 28th to May 1st, down in Florida. It's the Uncommon Knowledge Conference they have every spring. Last year was in Scottsdale. It was awesome. I learned a lot. That's the first place that I actually ever ran into you. And it was an absolutely great experience. And if I remember you saying you touched on it for a second, you can't make it to this one.
No, no, our co-founder Dave Wright will be there.
Okay, cool.
So
People have more questions.
I've always enjoyed going to the NAAIM conferences. It's great to talk to people. It's great to get feedback from people and just to be able to listen to various presentations and just to sort of be able to sit down and think and just talk with people and share ideas and opinions. And it's always a great conference. And I always pick up a few things to take home and implement, and so it's really good.
I think it's one of the few places that I've gone that you can come with your preconceived ideas in a box, sit down, and be presented from a bunch of different angles, a bunch of different data, and be surrounded by a bunch of other people that understand the topic, and then go and have intelligent conversation throughout the day and the evenings and talk about all this stuff. And there's a lot that you might disagree with, and you find a couple things that you do agree with or that resonate with you, or that maybe you want to start implementing or doing differently, or it just opens your mind to a different concept, and it can change everything for you.
Yeah.
So anyone that hasn't been to one, get off the fence and go. It's a great conference.
Yeah.
And hopefully I see you then at Outlook in the fall.
Yes, definitely.
Okay. All right. Hey, Ryan, appreciate all your time. We look forward to seeing you again.
Thank you. Take care.